Instagram is live and we're live on Facebook. Good evening. I hope you've had a good week so far. Uh, it's been interesting for me today because I've been looking at the referendum in Germany where the government may buy back the best part of, I think, 249 properties, 249,000 properties from landlords. So that's quite interesting. Obviously, there's conversations about tenants' rights and all of that stuff. That's going on in Germany right now. So I'd be interested to hear your thoughts. I don't want to get political about it because you might or might not know that I have a background and a connection with politics. So I don't want to keep politics out of it, but I'd be interested to hear your thoughts in terms of what you think of that particular move. And do you think something like that could happen in the UK anytime soon? So post a comment and share your thoughts. So if you want to ask a question, by all means do so. So this is a pure live Q&A. I've had 4 or 5 questions. I'll answer those. If you have any questions, feel free to post those and I'll answer them as we go along. When you do type in a question, try and be as clear as you can in terms of what you're asking about, or if you can, very quickly give me a synopsis or a scenario. That helps me to answer your question in a bit more detail and kind of make it more precise to the situation or circumstance. I mean, I understand you're not going to post a whole essay, but if you can give me 2 or 3 sentences of what the scenario is and what the question is, that will help me to better serve you. All right, so we've got a question here from Simon Roberts, and the question is, would a parent shell holding company with a child, so he means a subsidiary, service accommodation limited company, and a separate child, again, subsidiary, buy-to-let or HMO limited company, be considered as an investment or trading business? So the question from Simon basically is, you've got a holding company. Beneath the holding company, there are 2 companies, one service accommodation, and the other one's a buy-to-let HMO business. Is that group structure going to be treated as investment or trading? And you'll know, Simon, if you're listening in right now, if you listen in later, the favorite answer of all accountants or most accountants and solicitors is it depends. It depends on the situation and scenario. So generally speaking, if 20% or more of your turnover, your profits, the value of your assets, the time spent on the investment business, it exceeds 20%, then your group will be treated as being an investment group. Therefore, you will lose trading status. What does that mean? Well, generally speaking, the government want to incentivize businesses and people who run trading businesses. So they offer quite a few different tax breaks or reliefs and incentives that aren't available to investment businesses. So, for example, entrepreneurs relief, which is now called business asset disposal relief, where you pay only 10% tax on the first £1,000,000, is only available to trading businesses. Investor relief, again, only available to trading businesses. R&D tax credits, only available to trading businesses. And business property relief or business relief, only available to trading businesses as long as the value of your assets isn't more than 50%. So that plus many other reliefs are only available to trading businesses. So if you're holding property as part of a group, and let's say you're running service accommodation and possibly doing commercial conversions or flips or building properties from ground up, if 20% of the value of your assets is from holding property, you will lose trading status. And that can be easily done because the scenario that Simon's here posed, the turnover from the service accommodation will probably be higher than the buy-to-let business, depending obviously on how many buy-to-let properties Simon has. But generally speaking, let's assume the turnover is higher. Let's assume that the service accommodation business produces more profit. Let's also assume that Simon doesn't spend more than 20% of his time on the buy-to-let business. Still, the value of the asset or the number of properties Simon owns, okay, over time, he's likely to breach the 20% on the balance sheet on that indicator alone, which means he will lose trading status. So where possible, I know I'm talking about ideal world, and it's not an ideal world, and the situation circumstances change. But where possible, you want to avoid buying property in your trading group. So best to have a separate limited company. If a limited company is the best way for you based on your situation. But best to have a separate limited company where you have all of your properties that you hold on to. So the investment element is a standalone company. Now, if you get into a scenario where you've got trade and investment and you'll maybe looking to exit the business, or there's something else going on where you want to claim certain reliefs, then you can do a demerger. And I don't want to get too technical or get bogged down with that detail, but you can do a demerger. You can move the investment element out into a separate company and then keep the trading group as a trading group. So that's something available to you, which isn't cheap, by the way. It's going to cost you quite a few £1,000s, but the tax saving or the value of the reliefs might be higher. So that's something for you to consider. But if you can avoid that, it's even better, because then you're not going to have to go through all that trouble. So we've got a question here from somebody on Facebook, which is asking, can an investment company hold a commercial property and a residential property, both investment and tenanted, or is it not recommended, and would it be better separately held by two companies? So generally speaking, I'd say if you're buying and holding property, be it residential and or commercial, and the ownership is the same. So let's say the person who's asked the question, there's two of them, and they both own all the properties 50% each. Then I would say there's no problem holding the residential properties and the commercial properties all together in the same company. It does get a little bit complicated and challenging, because if there's an option to tax on the commercial properties and there's VAT being charged, and your strategy, let's say, is to have 50% of your portfolio as commercial, 50% of your portfolio as residential, and you aspire to have, let's say, 10 commercial properties and 10 residential properties, then I would say probably better to have it in two separate companies, because on the commercial side, you'll also be claiming capital allowances, and you may have VAT implications. So I'd say if you're going to buy quite a few, then keep them separate. But if you've got, let's say, 10 buy-to-lets and you've got a commercial property or two commercial properties, then I'd say you can have them in the same one. But while I'm here, if you are looking to go into buying commercial property, then I would strongly suggest you look at setting up a small self-administered scheme for pension purposes, which is called a SAS. I can't give you investment advice, but if you are buying commercial property, there are many benefits and reasons for you to build up that pot and buy commercial property through that. Some of the quick benefits are all the rent that comes in, no tax to pay on any of those profits. When you sell the properties, no tax to pay on that either. So all the rent that comes in, you can recycle it 100% to buy even more properties. So from a purely tax point of view, it is a good idea to consider having a SAS. I mean, it's a good idea to have a pension anyway, but it's a good idea to have a SAS and buy commercial property through that. Another question from somebody, and they are asking about JVs, which is for a JV where one investor provides all the initial finance, but there is a bridging purchase and development. Is it expensive to? Okay, so I think they've got two separate questions here, by the way. So, okay, so that question is connected to the first one, where JV investor provides all the, but there is a bridging credit and development. I'm not too sure how that's connected to the first one, but if you've got somebody who's a JV partner and they are providing all the finance and own half the property, I can't see a particular challenge there. If they're getting bridging finance, which obviously people do quite often, again, I can't see a particular challenge there. So I don't think that's going to make a difference to a particular scenario if that's linked to the first question about having commercial and residential property together, as long as your JV partner owns all the properties. Because what you don't want is to then be a shareholder in a company where you own all the residential properties and they only own part of the properties, because that starts getting complicated with alphabet shares, all that type of stuff, and then you've got to keep on top of it. I'd say keep it separate if the ownership is different. MBA 007 is saying, is it expensive to set up a SAS? It depends what you call expensive, but when I set my one up a few years ago, it cost me, I think it cost an investment, but the fee was around £2,000 to set it all up. Then you've got the trustees who charge you a fee, and I think I paid either £100 or £125 every single month. So at the start, it's going to seem expensive, especially if you're starting from zero. But if you've got a pension pot because you were working elsewhere or you've been in business for a while and you've accumulated a pension, then you can move, possibly with advice, by the way, from a financial advisor, possibly move that pot over to a SAS. So you've got something quite useful there, and then move on to obviously paying those fees. It's going to be more palatable. But if you don't have a SAS and you've got to spend £2,000 and then you've got to pay trustee fees, and then there's a couple £100 to pay for legal fees as well, could be a few £100, by the way, then all of a sudden you've spent best part of say £2,000 to £2.5 up front. It might not be palatable to you. Plus you're paying best part of say £1,000 to £1,500 in fees to trustees. That might seem excessive to you, but if you're going to quickly build up the pot, especially where you've got a scenario of a husband and wife, doesn't have to be a husband and wife, by the way, could be 2 or 3 or 4 business partners, but let's keep it simple and say a husband and wife scenario where you're both contributing up to £40,000 every year. Then within a couple of years, hopefully that's going to be worthwhile for you, because once you've got £80,000 each, so 160 grand in total, you could buy a small commercial property and make it work. I was offered one today where the rent is 10% of the value of the property. It's on for £150,000. The rent's £15,000 a year, which is pretty decent, by the way. So you can buy lots of those type of small properties through your SAS and get 10% yield, which is pretty good going. You won't always get that on bigger commercial properties. So that's something that you ought to think about. What's another question from MBA 007, which is what sort of specialist would you need to speak to? You need to speak to MBA 007 and IFA. If you don't have any contact, if you send me a message on, you can either email me or send me a message on Facebook Messenger. I'd be more than happy to answer your question. My email is shaz, SHAZ, at aa-accountants.co.uk. I'll type it in the comments box and you should be able to see that, or I'll try and add it to the banner as I'm going through tonight, MBA 007, and that should hopefully then give you an opportunity to contact me, and I'll happily recommend somebody to you who I use, and you can have a conversation with them, and if you feel they're right for you, work with them. They've been very good to me, and I'm sure you'll get exactly the same service, if not better. Have another question from somebody, which I'm going to have a look at in a second, while MBA 007 writes down my email address. And the question is, can a buy-to-let property be transferred into a child trust? If so, tax efficiency way of doing it and any consideration to be aware of. I'm not too sure why you'd want to transfer it into a child trust. I've not seen that done, by the way. I've not heard of it being done. So on that one, I've not got experience of that, to be honest with you. But if you give me a particular situation or scenario of why you would be doing that from a tax point of view, and if it's doable from a legal point of view, then I'll be more than happy to look at that for you. A question from Yoko. Hi, Yoko. Nice of you to join us. And the question is, thanks, Shaz, about limited structure of holding company and rest under one point. It was me asking that question. Okay, fine. All right. Well, that's 2 now, Yoko. So we had Simon Roberts who asked that question, and obviously you've asked that question too. So thank you for asking that question. And there's another question that Yoko asked. In fact, I'll answer that for you without hopefully embarrassing her. She's been told that if somebody owns buy-to-let properties, they're a high rate taxpayer, and Section 24 affects them, and they enter into a rent-to-rent deal with somebody else, then Section 24 will not affect them. And the answer to that is no, that's not correct. Section 24 will still affect them, because if they do a rent-to-rent deal with, let's say, at an arm's length to a third party, the rent that they are receiving is still rental income. And if they're still a high rate taxpayer, then the interest that they're paying on those properties will be caught by Section 24. So they won't fully escape the hold of Section 24. But if they're getting less rent, then of course the impact of Section 24 will be reduced, Yoko. So I hope you find that helpful. But if you've got a follow-up question, feel free to send that to me. MBA 007 again. asking if you buy a commercial property that is opted to tax as a transfer going concern into a new SPV with retail below and vacant uppers for conversion. Any smart tax plan to consider if you want to convert upstairs to residential. Yep. So if there's VAT on the transaction, as you've said, there's an option to tax. If you're doing a transfer going concern MBA, then I assume that you're taking on that property with a sitting tenant because that's the only way you can do a transfer going concern. The good news for you there is you won't have to pay VAT on the transaction because it's a transfer going concern, which means you won't have to find the cash for the VAT and you won't have to go and pay interest and then try and claim back the VAT from HMRC. So that's one benefit. The other benefit for you is when you pay stamp duty land tax, you pay it on the purchase price of the property plus the stamp duty land plus the VAT. So if you're buying a property, let's say for £500,000 and there's 20% VAT on it, the SDLT you would pay wouldn't be on the 500 grand, it would be on the £600,000. So by doing a transfer going concern, you're going to pay some stamp duty land tax. Now moving forward, of course, if you're then going to convert the uppers, you've got two choices. If the uppers are vacant, then you can complete a VAT 1614D and give that to the vendor. If they accept that, then the uppers aren't caught by the option to tax, but obviously the ground floor would be. But if you've got a sitting tenant there, then you won't have to pay VAT, but you'll have to register for VAT going forward, because even if you do the transfer going concern, you have to register for VAT. So I would look at a VAT 1614D. That would be your best way around that MBA. Another question from MBA. Thank you for your questions, by the way. And it is, recall you have bought land before in LLP and once planning is gained, you switch limited company, uplifted it with base value. Yep, that's correct. So it wasn't land. In fact, we bought a commercial property, then obtained planning to convert it into 12 flats. And once converted, we then moved the property into a limited company. And what MBA is referring to in terms of the uplift in base cost, let's say you buy a property for £500,000. You then obtain planning on it in our scenario for 12 flats. And let's again assume just a random number. Once you obtain planning, that property now isn't worth 500 grand because it's increased in value. It's worth £650,000. Then you carry out a refurbishment on the property, and that let's say cost you another 500 grand. So you bought it for 500 grand. You've spent £500,000 refurbing it. Let's add the £150,000 extra value that you created by creating those flats. And let's say after you finish the refurb, there's another, again, I'm keeping the numbers easy, there's another £150,000 value that you've created. So all in all, you bought it for 500 grand, you spent 500 grand on it, and you've created an additional £300,000 in value. So the property is now worth 1.3 million, but it's costing you £1 million. If you move that into a limited company, then the base cost of those properties will be £1.3 million. So if you then sell that property through the limited company for £1.5 million in a year's time, then the corporation tax you're going to pay is a 1.5 million less than 1.3 million. So you're going to pay corp tax on 200 grand. But if you sold that personally for 1.5 million, you'd have paid tax on the 500 grand, which is 1.5 million less the £1 million. So you'd pay tax on £500,000. So that's how that works, MBA. And it's as long as you can justify that you have a business, and when you've got 12 units, for example, then you're more likely to be able to persuade HMRC that you have a business. Then you can incorporate using Section 162 incorporation relief, and there's no capital gains tax to pay. Now, we bought that particular property, just to finish up that scenario, as a partnership on day one, and later on we incorporated, so there was no stamp duty land tax for us to pay either, because when a partnership incorporates under the current rules, there's no stamp duty land tax payable, again, if the ownership stays exactly the same, which it did in our scenario. If obviously you were the only sole owner and you want to incorporate, then you'll have to consider the stamp duty land tax implications on that particular transaction. Questions are rolling in thick and fast today, which is fantastic, by the way. Thank you for all the questions, everybody. Hi, and another question, which is hi, great to tune in with a new limited company. Can I extend the annual returns at the end of the first year, and for how long? So I assume what you're saying is, can you extend the year end? Yes, you can extend the year end, but I would say to you, think long and hard about that. So unless there's a good, genuine reason to extend the year end, I wouldn't do it, because once you've extended the year end, you then can't do it for another 5 years. So something else might happen in the future where you may wish to extend the year end. So what I would do if I were you, and I don't know your exact scenario, by the way, rather than extending the year end, I would reduce the year end. So make it shorter than a year, and then if your company's been dormant for that period, file dormant company accounts, and then obviously the next year end is going to be in 12 months' time from the to the date that you shorten it. So that will buy you more time. That's better. You can reduce the year end as many times as you like, but you can't extend the year end once you've done it for another 5 years. So have a think about that carefully. Another question from Yoko, I think, is to do the rent to rent. What the rent to rent investors paying the landlord as a management fee and not exactly rent, and the contract says is a management fee if the mortgage isn't a buy-to-let mortgage? I think that the challenge there, Yoko, in a roundabout way, is if it looks like a duck, if it flies like a duck, if it quacks like a duck, it's a duck. So we can if what we can do is if I think HMRC looking at that arrangement, Yoko, they will say, although you're presenting this as a management fee, this is basically rent being paid to you because you're giving your property to somebody else. And yes, they're turning it into an HMO or doing something else with it, but it's rent being paid to you, being dressed as a management fee. So I don't think that's going to wash, to be honest with you. I don't think it's going to work. You can have a strong legal document, but at the end of the day, you've got a property, you're giving it to somebody else, they are paying you rent to take over that property. So to be the bearer of bad news. I think I did say quack like a duck, but I might have said something else. I did mean quack. Okay. Another question from MBA. So actually, if you want to convert uppers, then would buying into an LLP be more optimal, and then once converted, move to a limited company if you want to sell or rent the units? That is a good option, MBA. I can't say to you whether that's right for you or not, because I don't exactly know your scenario, but thank you very much, MBA, for pointing out quack, quack. And, the accountants slip up more than anybody else, especially when talking about ducks, by the way. So from now on, I'm going to try and make sure I don't talk about ducks. I'll have to find a different example, thanks to Yoko. But if you've got enough units upstairs, by the way, so if you've got 3 or 4 units upstairs on the uppers, that's not going to qualify as a business. If you've got, let's say, 8 or 10 or more units on the uppers, MBA, then there's more chance of you being able to demonstrate that you have a business, in which case, yes, you could then convert that or move the property from an LLP into a limited company, as long as you're buying it as a partnership or through an LLP to start off with, which is exactly what you said in your question. So that should work okay for you, but consider all the scenario before you kind of go through it and make sure it works for you. Okay, next question. We've got a webinar, in fact. So I'm thinking so much about ducks and quacking, I forgot about the webinar. So we're running a webinar at the end of this month here, and although part of the questions already been asked, we did a commercial conversion on a property where we saved well over £100,000 in tax, and I've been asked this question on numerous occasions, although I have done a short video on YouTube. So I'm going to go into detail, talking you through exactly what we did with that property, or talking about capital allowances, talking about incorporation, talking about land remediation relief, and a few other things to show you how we created over £100,000 in tax savings, all above board, legal, nothing risky, pacey. I'm not into that type of planning. I like plain vanilla, sensible planning, which works and stands the test of time. So I'll talk you through in great detail exactly how we did that to hopefully raise your awareness to show you what you could do and how you can add value by tax savings and being sensible in terms of your business structure. If you've got any questions, by the way, and I don't cover them today, you can email me on shaz@aa-accountants.co.uk. I'll be more than happy to answer them. Do we have any more questions here, or are we done? Let me have a very quick look. Yeah. So MBA saying they may have more than 8 units. MBA, that's worth considering. Drop me an email. I'll have a look at it for you. And if it works for you based on your scenario, more than happy to talk you through that. MBA is also saying, I love the New England project. Watched all the videos at least 3 or 4 times. Fantastic. If you've got any questions on that MBA, feel free to ask me. And again, happy to talk you through your scenario when the time is right. That's the link for the webinar. I did promise last week I would create a bit.ly link, but I've got so busy thinking of other stuff. I forgot. I promise you next week I will have a bit.ly link for you to save you posting or using that long URL to make it easier for you. And Yoko said she's going to share that in her Tigers group. Thank you very much, Yoko. You're always fantastic. You're always being very supportive, so I appreciate that. But take that link down or join us next week, and I'll have a shorter link for you. Come to the webinar where I'll be sharing content, but I'll also be happy to answer any questions you've got on any of the tax relief that I'm going to be sharing with you on the night. Until next week, bye for now, and thank you very much for tuning in, and thank you for all your questions. It's been fantastic.